I'll say anecdotally, Alistair, I think we kicked off the year with a nice bump in venture capital, new deals. And that happens every year where people feel like, okay, it's a new year and I've got to allocate or deploy, let's say 10%, at least 10% of my fund every year. That's not going to upset my LPs even if DPI is low. Let me go do that. And so we've seen a nice pickup in venture. We see a lot of discussions about M&A transactions and a lot of planning for M&A transactions, but we haven't seen a lot get announced.
Hi everyone, this is Alistair, and thanks for tuning in to the Venture Variety Show. This week's guest is Louis Lehot, an attorney with the law firm Foley & Lardner. And Louis and I recorded this podcast before the recent trade wars, before the recent tariffs erupted and then retreated amid some backlash. But the points Louis makes in this podcast are still valid. He talks about venture exits with IPOs and M&A. He talks about uncertainty in the market, about risk, and he also has some great advice for founders. So if you work in venture or you're a startup entrepreneur, you should really get to know who Louis is. So let's jump in and meet Louis.
Thanks, Alistair. I've been at Foley & Lardner for 4 years, and I'm part of a team of 45 lawyers that focuses exclusively on emerging growth companies. We'll take them in all stages of growth, from 2 girls, a laptop, and a dog, and sometimes no laptop, all the way through a public company and exit and beyond. I help startups get formed, financed, scaled for growth, bought and sold. And I have a lot of fun doing it.
That's great. So primarily you work with companies, but I understood too that you work with in all aspects of venture capital. You've worked with investors,
yes,
correct? GPs and LPs.
We certainly have a lot of friends who have venture capital funds and who are raising capital, deploying capital, and hopefully returning capital to their limited partners in the near term. This word called DPI is on the tip of every tongue in Silicon Valley right now. Can you monetize an investment that should be in the money and return capital to investors so that they'll be willing to deploy new capital? And one of the issues we've been dealing with in the last 2 years, Alistair, is that the levers of the venture capital system have been gummed up because DPI, or distributed proceeds of investment, has been blocked, and that's because the IPO window has been closed. Interest rates have been on the increase and stabilizing. And then the government in Washington has had an anti-M&A stance such that big tech buyers really couldn't be in the market. And so the normal pace of startup finance, exit, and then wash, rinse, repeat has been stopped because there was no exit in the last 2 years. So what happens is that even though venture capital firms have received commitments from their limited partners, they don't want to be calling on those commitments until they've returned a little bit of more capital. And certainly limited partners are not going to commit any new capital until they get some more capital back. And that's that ratio of DPI, of distributed proceeds to investment, that needs to come up, and that we hope in the year ahead we'll see some progress.
Well, that's a great point. And I was just going to ask that. Are we going to see some returns this year? There's hope. Hope is not a strategy, as they say. I mean, what does your outlook say? What do you think is going to happen?
Well, first I'll talk about the IPO window, because I think 2025 ought to be the year of the IPO. We've had 2 really slow years, especially in terms of technology IPOs. And so there's a backlog of very strong companies that have the profile of a company that would be very successful in the public markets. And so the quintessential one that everyone's waiting for is Stripe, this very large multi-decacorn company that is, the big 800-pound gorilla that really runs the rails of fintech and payments online now for many businesses. And so we should see that one go out and get public. Databricks is another one in the cloud space, that in big data space, that we should see come out and go public very successfully, given its size, its revenue, and its growth rate, not to mention profitability. And then you've got hundreds more companies, particularly in the cybersecurity space, where we think that there are companies that are really prime targets. What makes a company ready to go public? And I'd say you have $100 million of revenue, You have at least $1 billion of valuation, preferably 300 million of revenue and 3 billion of enterprise value. And then you have a stable outlook for the next 8 quarters such that an investment bank feels comfortable telling their best customers that the near term outlook, over 2 years is positive and that they can kind of draw it out on a graph. So if you unite those things, you've got a good cohort of companies. Then you have to have an open window. And what's that? An open window, Alistair, is when investors feel like betting on the sector. And that's because looking at the IPO asset class versus other asset classes, it looks attractive. And so first is risk has to be on. So an IPO by definition is risky because it's never had a trading market before, and there isn't a history of meeting or exceeding Wall Street targets. And there is also not a history of trading volume. So people are really betting that you're not only the price is going to go up, but that there's going to be an orderly market such that if you need to sell, there's a buyer there that's willing to take it off your hands. So that's what we call risk on. And generally for there to be risk on, interest rates have to be stable such that an investor doesn't say, well, why wouldn't I just buy some treasuries and hold on to those because I can get 5% or 6% on my money for sure rather than betting on this thing. And so we look at interest rates. They appear to be somewhat stable, at least not looking like they're going up according to all the indicators that we have, number one. And then number two, you have a decent fiscal outlook. Inflation seems to be under control. And lastly, you look at other indicators of risk, like digital assets, like biotech. And digital assets have been very strong, obviously, in the last 3 months, given the change of administration, although biotech is a little bit depressed right now given the uncertainty with the MAHA movement, which is now taking control of our healthcare system. So there's a lot of balancing factors. Does the IPO window look like it's going to be open or not in the year? And it looks to me like we have all the elements of what should be a good IPO year, a great backlog of companies, and we have at least a stable outlook with some elements of risk on. So that's one part of exit, IPO, and then the other one is obviously M&A. And as you and I have talked about before, the Trump administration has given us kind of two very mixed signals about what it thinks of M&A. On the one hand, they appointed Andrew Ferguson to chair the FTC, and Andrew Ferguson has made public statements that his agenda is going to be ensuring that there is equal ability to make free speech on platforms, and that he's going to take away the focus on that Lena Khan had put on what I'll call competition factors like impacts on labor and employment and diversity and inclusion. So Andrew Ferguson looks like somebody who would be very pro M&A and would help open up the floodgates that are extremely blocked. Now, on the flip side, at the Justice Department, Trump appointed Gail Slater to lead the antitrust division, and Gail Slater has a more activist and more Lena Khan-esque view of the market and her role. And one of the first things she did was to block the merger of HPE and Juniper Networks, which was, I think, a big surprise to the market, at least. That one was one that I think people thought the Biden administration would have let through. And so it was kind of a head turner that Gail Slater's Justice Department came in and sued against to block the merger. And lastly, she has said she's going to pursue the United States government's lawsuit against Google and its search engine for having what the government believes is some sort of a monopolistic position. I would say the nuance between her view and the Lena Khan view is that she's looking for accommodations rather than a breakup of Google. Nonetheless, do we think the M&A market is going to be open for business? Are big tech buyers going to be able to get back in the market and assume the place that they once had? And just to put this into perspective, before the Biden administration, the big 7 tech buyers could be counted on to do 20 to 30 acquisitions a year. Most of these would fly under the radar. They're less than $100 million. They don't get reported to the government, and they're to acquire teams of 5, 10, 20, 30 engineers and to pursue new adjacent technology products and services in order to achieve growth. And at the beginning of the Biden administration, Lena Khan sent a subpoena to all the big tech buyers and wanted to know about every single transaction that they had done on an unreported basis, and sent the signal that any kind of activity in the M&A market would get scrutinized. Essentially, you're closed for business. We haven't heard that kind of message from the Justice Department, but by the same token, we haven't seen the floodgates open. Lastly, I would say that there are a lot of signals of uncertainty that are coming out of the Trump administration as it establishes itself. So, while as I think in November, December, there was a lot of hope that M&A would have a flying start in 2025, I think we're in a bit of wait and see mode as Trump administration and his various appointees take the kind of actions that they promised us they would take, which are going to create a lot of disruption and chaos. And I think it's June or July before we're in a different situation.
No, I was just going to ask you to look into your crystal ball and come up with a timeline. So mid-year, third quarter kind of anticipation of opening up of markets there, IPOs and M&A, you think?
That's what I'm hoping.
Yeah. Yeah, you've mentioned uncertainty a little bit, and you've talked about that. How's that impacting investors and founders more so? What, excuse me, what factors are causing hesitation and this uncertainty right now? I mean, you've kind of outlined a few with the administration and the appointment of personnel, Andrew Ferguson and Gail Slater, but are there any other factors that's causing uncertainty?
Sure. Yeah, I think that at a really macro level, you've got war going on the European continent, and you've got what looks like a very tense situation in the China Straits with Taiwan, and they of course are where most semiconductors are manufactured in the world, and where we have the deepest technology bench. You zoom in a little bit further and into the U.S., and you have the Trump administration talking about implementing trade tariffs and export controls in a variety of ways against countries that we've never thought of as countries where it would be risky. For example, the last 30 years, you've had a booming industry in the north of Mexico, or maquiladoras, where lots of parts for our automobile industry are manufactured. Some automobiles are even assembled. Lots of electronics parts are assembled and brought into the U.S. And the administration has also sent signals that if certain manufacturers, set up big plants there, that they'll do more than 25% tariffs. They'll take some other punitive action. And then the impact of all of these things on the greater economy is a big question mark. And so I think if you're looking to make a big bet on something, you might say, I might just hold off and wait until the dust settles and see what this looks like in June. I'll say anecdotally, Alistair, we kicked off the year with a nice bump in venture capital, new deals. And that happens every year where people feel like, okay, it's a new year and I've got to allocate or deploy, let's say 10%, at least 10% of my fund every year. That's not going to upset my LPs, even if DPI is low. Let me go do that. And so we've seen a nice pickup in venture. We see a lot of discussions about M&A transactions and a lot of planning for M&A transactions, but we haven't seen a lot get announced. And then on the IPO front, same thing, a lot of chatter, but nobody's wants to be the first. So that's kind of where we are.
Yeah, you mentioned waiting for the dust to settle. Well, backing up for a moment, your expertise is across sectors, right? Technology, healthcare, energy, whatnot. For founders in those in any industry, or any founders out there, basically, what advice do you have to them? If they're looking to raise capital, is it just to be patient? Is that the biggest advice you can offer to a founder right now? Wait. We're waiting for things to shake out, waiting for the dust to settle. What should founders be doing at the moment?
Well, I think that every business needs to look at AI and how they can automate and take advantage of those technologies to be more competitive from both a revenue perspective and a lower your cost perspective. And so the businesses that integrate AI technology the fastest and the easiest to implement for customers are going to zoom ahead. And I think the Trump administration has been very clear that they're going to leave AI as a sandbox, and they're not going to regulate it for the time being until these businesses get more mature and they've figured out how to monetize. And so I think AI is a real bright spot. and a place for companies to really spend time. In terms of raising capital, the best capital is the money that comes in from customers. And so for anybody that needs to raise capital, I would start there with customers. And what we often see is multi-year deals where customers will pay up front 2 or 3 years and maybe get a discount for the benefit to the company of having contributed that cash. We're seeing more debt providers in the market.
Yeah.
And so I think debt capital is something that is loosening up and becoming easier to get. But of course, lenders never want to give you money unless you don't need it. So the best time to borrow is when you raise equity. And then as far as raising equity, I think now is a good time to be out in the market talking to investors because they do feel a little bit more confident at the beginning of the year. And so I wouldn't be waiting to raise capital until the dust settles in June. I'd be at it real hard right now. There are some other real bright spots in the tech sector. I think the creator economy continues to be a place where we see a lot of investors and entrepreneurs making new businesses that can profitably offer products in the climate change space will continue to be attractive. I think that while we're likely to see less regulation there in Washington, and so some of those businesses may not make sense, anybody that can make your business more profitable by decreasing the amount of energy you use is going to be something that's certainly useful, but not on a government subsidized basis.
Well, I like that. And you mentioned debt capital. That teases an upcoming podcast. I'm talking to a debt lender soon. And you mentioned AI for a moment. I had in mind to ask you about that. And, investors don't just put money into AI companies. They also use AI for deal screening and, help with supporting their portfolio companies with market data. Are you seeing that having an impact on the investment process? How more investors are using AI? Is that impacting founders? Is it impacting the whole venture ecosystem?
That's a great question. There are a couple funds that I know of that are using AI to analyze trends in the market to find signals and identify both trends in the market and companies that are at the right inflection point to go and do investment. And I think there are just a plethora of tools out there, Alistair, that investors are using, but there isn't any industry standard or anything that's coming that I see. I just think investors are using their own, what I'll call home cooking to do what they can in that regard. And it's very early days.
Hey, just kind of a personal observation is, I've noticed, I was a journalist for a few decades. I went to courthouses. I've interviewed lots of attorneys over the years, and even worked with attorneys on guest post, and even now in my client aspect, I'll work with attorneys on making sure content is compliant and whatnot. Long intro here. So most attorneys I worked with are more reserved and cautious in how they engage publicly. Just an observation, I see you're active on social. You comment a lot on LinkedIn, and you post a lot. You write a lot as well. Just kind of curious, what's inspired you to be so active as an attorney, to be so engaging, on social? Was that an intentional kind of movement on your part? You wanted to get out there and connect with clients?
Yeah, that's a great question, Alistair. And I hope that it's clear that I love what I do and I have fun doing it. So
Absolutely.
We start with a passion, and I'm a people person. And I would say that my approach to the communicating with the greater world changed drastically during COVID, when I couldn't go out to an event. I couldn't engage with people socially like I used to. And so the only way to do it was through a podcast or through a blog. And so it was right at the beginning of COVID that I launched a website, and I started a podcast series called Ask a Silicon Valley Lawyer, and produced some videos, because really that was the only way to engage with people. And once I kind of built the platform, if you will, or the must to get those messages out, I just kept doing it, and it kind of picked up a momentum all of its own. And sort of that's kind of how it happened. But obviously, as lawyers, we can't be talking about our clients publicly, and so I'm always very careful about speaking about macro and micro trends rather than any particular company or client.
Well, hi everyone. I hope you enjoyed that podcast conversation with Louis Lehot, an attorney with Foley and Lardner. Please remember to like and subscribe and follow me on Substack, on YouTube, and I'm on Medium and other platforms as well. And be on the lookout for more content involving Louis. I asked him about AI's impact on the legal industry, and that cut is going to be included in a separate post I'm doing on legal tech and jobs. So be on the lookout for that. For now, thanks for tuning in to the Venture Variety Show, and we'll see you next time. Bye-bye.